Up to 1 million Australian households are set to default on their mortgage repayments by September. That's the warning from one independent analyst. If the big four banks increase their mortgage rates by as little as 15 basis points over the next few months, that would mean an extra $60 a month in home loan repayments for the average household. Earlier this week, Macquarie Bank was the latest lender to hike its variable mortgage rates. Now, all eyes are on the big four. Our business reporter David Taylor looks at the pressure they face to raise their rates to protect their profit margins.
It's a question of when, not if, the big four banks will raise the interest rates on their home loan products.
I'm almost certain that they will be forced to lift those rates. It's a question of timing and, of course, the political reaction when it happens.
Martin North is the principal of Digital Finance Analytics, an independent financial research firm. A significant portion of Australia's banks are already starting to lift their interest rates. Macquarie Bank, not one of the big four, but with similar funding access, will raise variable rates on owner-occupier loans for those paying principal and interest by 0.06 percentage points on Friday. Those paying interest only will have their rate upped by 0.1 percentage points. It follows similar moves by AMP, the Bank of Queensland, Suncorp and ME Bank. So the big question is, when will the ANZ, Westpac, the Commonwealth and the National Australia Bank move their rates higher?
I think that by September we will see these rate rises in place, unless the international financial markets change direction quickly, because the pressure is building and it will continue to build. We're going to see the Fed raising rates further in the US. We're seeing the funding costs really not adjusting back very quickly. So I think that they've probably got to do something.
The Commonwealth Bank is Australia's biggest home loan provider. Michael Blythe is the bank's chief economist. The ABC asked Mr Blythe if he could shed some light on when the CBA would make its move on interest rates.
Look, all banks are facing the same issue. Part of that funding pool that they draw on, be it domestically or overseas, we have seen some upward pressures on interest rates in those areas.
How do you reconcile that pressure that the big four banks face in raising rates and the fact that the Reserve Bank hasn't moved to raise rates because the economy is vulnerable? How do the banks weigh that up? I mean, obviously you've got profit margins to protect, but if the Reserve Bank hasn't done it, then what makes Macquarie think it can do it, for instance?
I mean, what the Reserve Bank is making very clear, though, I think, is that the next move in interest rates is going to be up. But equally, they're making it very clear that they're in no hurry to act on that side of the story.
But yet the banks are moving, though. So do you see my point? Would the banks feel comfortable in raising rates, considering that the central bank isn't?
If some banks are increasing their mortgage rates, that will feed into the Reserve Bank's decision about what it will do with its own policy interest rate.
Katrina King is the Director of Research at Queensland Investment Corporation, specialising in debt. She was a little more forthcoming, explaining that the banks are facing increasing pressure from shareholders to maintain their profit margins, and that means raising rates.
I think that they do tend to have to listen hard to their equity investors as well, and with their cost of funding increasing, this may be some way for them to alleviate the pressure on their net profit and the expectations for their profit and be able to reward their shareholders. So the pressure's certainly there.
QIC's Katrina King, though, says most households can relax, expecting interest rates to only move up a fraction from where they are now.
With the sort of funding pressure that we've seen in the front end, they may only need to raise rates sort of 7 to 10, maybe 15 basis points in order to alleviate the pressure on them.
Banking analyst Martin North is not as relaxed. He says he expects the big four will raise rates on standard variable mortgage rates by at least 10 to 15 basis points or 0.15 percentage points to cover the increase in their cost of funding. Mr North has been quoted widely warning of the dangers of raising interest rates while many households are already suffering mortgage stress. He warns that even a 0.15 percentage point increase in interest rates would push close to 1 million households into mortgage default.
Okay, so today, 975,000 households across Australia with owner-occupied mortgages are right on the edge now. Right? And there are around 50,000 who are already over the edge and are already looking like they could well default. If rates went up by, let's say, 10 or 15 basis points, that would go up closer to the round million households. In other words, enough to make a difference. Not not a vast number, but, if you go from 975,000 to 1 million, that's enough to notice.
The mathematics are complicated. In Sydney, for example, a household with an average $750,000 mortgage will have to pay an extra $60 a month if their interest rate rises by as little as 0.1 percentage points.
But it's that marginal borrower, it's the borrower who's already up against it, who's got little wriggle room, who's already struggling with childcare costs and, the other fuel costs, electricity costs, even a small rise. And remember that the income growth is nowhere. Costs are continuing to rise. So this is all part of building more pain in.
The Reserve Bank has made it clear it's in no hurry to raise interest rates. So where is the pressure coming from? Well, Australia's banks don't just follow the Reserve Bank's move on rates. They're also dependent on interest rate rises in other money markets. We know the cost of sourcing funds is rising overseas, especially in America. But the cost of borrowing money domestically from within Australia is also rising. That's because the Trump administration has asked many major US companies to pull out from offshore investments, including in Australia. It's part of its tax policy. As companies like Google and Microsoft withdraw funds from Australia's money market, the price or interest rate of the remaining funds goes up.
It's become significantly more expensive for Australian banks to fund themselves. For example, a 3-month bank bill swap rate was about 1.7% through most of 2017 and is now sort of 2.1%. So it's costing them a lot more to fund.
It raises the question of whether the nation's central bank will actually step in to ease the pressure on Australian households by cutting the cash rate. Shane Oliver is the head of investment strategy at AMP Capital. He says the Reserve Bank may well be compelled to cut interest rates, and not just to relieve household debt stress, but also to keep the entire economy afloat.
It's hopeful that the consumer will eventually come to the party. The risk is that'll take longer than expected, and the Reserve will have to stay on rates for a lot longer. In fact, we don't see the Reserve Bank raising interest rates till 2020 at the earliest, and I'd have to say you still can't rule out the next move being a cut rather than a hike.
That's AMP Capital's Head of Investment Strategy, Shane Oliver, ending that report from our business reporter, David Taylor.